Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Hey everyone, and welcome. Today we're diving into a really important change coming out of the Financial Accounting Standards Board, FASB. They've rolled out a new rule that's all about simplifying how companies account for loans they buy from other institutions. And honestly, it fixes a problem that was, well, kind of weird and counterintuitive. So let's get right to the heart of it with this question. If you're a company and you buy a loan, you have to think about the risk, right? The chance that the borrower might not pay it all back. How do you put that on your books? You'd think there'd be one straightforward answer, but for a long time, there really wasn't. You see, the old system basically created this fork in the road. Every single time a loan was purchased, accountants had to decide which of two completely different paths to take. And this choice, well, it created a ton of extra work and led to some pretty bizarre financial reporting outcomes. And here are those two paths. On one side, you had what are called PCD loans. That's purchased with credit deterioration. These are the loans that already look a little shaky. For them, you'd use a gross-up approach. Basically, you'd bake the expected loss right into the loan's value from the start. No immediate hit to your profits. Simple enough. But then, for the perfectly healthy loans, the non-PCDs, it was the total opposite. You had to immediately take an expense for any expected losses, a direct hit to your earnings on day one. Strange, right? So what was the big deal? Well, investors and companies started telling FASB, hey, this is confusing, it's inconsistent, and it just doesn't make economic sense. And the core of their argument came down to this one major flaw they called the double count problem. This quote from stakeholders really nails it. Think about it. When you buy a loan, the price you pay, its fair value, already reflects the risk. You're not going to pay 100 cents on the dollar for a loan you think might have some losses down the road. So stakeholders rightly pointed out that recording a separate expense for those exact same losses, well, that's like counting the same loss twice. Here's a really simple way to think about it. Imagine you go to a store and buy a sweater that has a small hole in it, so you get a 20% discount. That discount is for the hole. The old accounting rule was basically like going home and then, on top of that, writing down in your budget a separate 20% expense for the hole you already got the discount for. It just doesn't reflect the reality of what happened. So yeah, this was a real mess. The old standard was way too complex, and because companies applied it differently, it made it super hard for investors to compare one company to another. That double count thing wasn't just weird, it actually distorted the financial picture and could even make a loan's return look artificially high later on. It was clear a change was needed. And guess what? FASB listened. They came back with a new update that's designed to cut through all that confusion and create a single, much more logical way to handle most of these purchase loans. The big solution revolves around expanding the use of that gross-up approach we mentioned earlier. And it makes so much more sense. You figure out your expected losses, and you just add that number to what you paid for the loan to get its starting value. Boom! It completely avoids that weird, illogical day-one expense for losses that were already baked into the price. Now, to make all this work, the update introduces a brand new category of loan. So instead of just having the bad PCD loans and the good non-PCD loans, we now have this middle group that gets this better gross-up treatment. They're called purchased seasoned loans. Okay, so what exactly is a purchased seasoned loan? Well, first off, it can be pretty much any type of loan except for credit cards. Critically, it has to be a healthy non-PCD loan. And then it just has to meet one of two conditions. Either it was bought as part of a bigger business deal, or, and this is the big one, it was bought more than 90 days after it was first issued by a company that had nothing to do with creating it in the first place. This makes the new decision process so much cleaner. You just ask, does the loan have credit problems? If yes, it's a PCD loan, use the gross-up method, same as before. But if no, you then ask if it meets those new seasoned criteria. If it does, great, it's a purchased seasoned loan, and you also use the gross-up approach. It funnels so many more loans down one single consistent path. All right, so we've covered the mechanics of the change, but let's pull back for a second. What does this actually mean in the real world? Why should you, whether you're an investor, an accountant, or just curious about finance, actually care about this? Well, the benefits are pretty huge. First, investors get much better comparability. You can actually look at two companies' books and know you're comparing apples to apples. Second, life gets a lot simpler for accountants. But the biggest win, really, is that the financial statements will now show what's actually going on with the transaction. And of course, it finally puts an end to that frustrating double count problem for a whole lot of loans. Now, this isn't happening tomorrow. The new standard officially takes effect for fiscal years that begin after December 15th, 2026. But keep an eye out because companies do have the option to adopt these new rules early. So you might start seeing this change pop up in financial reports sooner rather than later. And that really brings us to the big picture question. This whole update was a direct result of people in the industry asking for less complexity and more common sense. It really makes you wonder, is this just a one-off fix, or could this signal the start of a bigger trend towards simplifying financial reporting across the board? It's definitely something to keep watching. Thanks so much for joining us for this explainer.